Imagine spending hours researching stocks, watching charts, following the news, only to realize you still performed worse than a simple buy-and-hold strategy. Sounds crazy, right? But this happens to most investors. So today we're going deep. Active versus passive investing. Which one really wins and why? Welcome back to the channel. If you're serious about building wealth, this is one of the most important decisions you'll ever make. In this video, we'll cover what active and passive investing really mean, the hidden costs most people ignore, real-world performance differences, and how to choose the right strategy for you. Let's get started. Active investing is the strategy of trying to outperform the market. Instead of accepting average returns, active investors aim to do better by making smarter decisions. This includes stock picking, choosing winning companies, market timing, buying low, selling high, sector rotation, moving money between industries, using technical and fundamental analysis. Example, an active investor might buy tech stocks before a boom, then sell before a crash. But here's the challenge. To win, you don't just have to be good, you have to be consistently better than everyone else, including professionals. Passive investing takes a completely different approach. Instead of trying to beat the market, you track the market. You invest in funds that mirror indices like S&P 500, total market indexes, global market funds. Key idea is that you accept average returns because historically, average has been very strong over time. For example, if the market grows 8% annually, your investment grows roughly the same without needing constant decisions. This is where things get interesting and where most people go wrong. Active investing often includes trading fees, fund manager fees, higher expense ratios. Even a 1 to 2% annual fee can reduce your total wealth massively over decades. For example, $10,000 invested over 30 years at 8% return is about $100,000. At 6% after fees is about $57,000. That's nearly half gone due to fees. Active investors trade, frequently resulting in more taxable events. Passive investors hold long-term, so fewer taxes. Active investing increases the chance of panic selling during crashes, overconfidence during booms, chasing trends. Passive investing removes most of this by design. Active investing risks includes wrong stock picks, bad timing, concentrated portfolios. Passive investing risks include market crashes affect you fully, no downside protection. You can't avoid bad periods. So active investing has the possibility of reducing risk, but only if done correctly. Otherwise, it often increases it. Active investing might be right for you if you genuinely enjoy analyzing businesses. You're willing to spend significant time learning. You accept the risk of underperformance. You treat it like a skill to master, not gambling. It's closer to a profession or serious hobby than a simple strategy. Passive investing is ideal if you want long-term wealth with minimal effort. You have a job or business to focus on. You prefer consistency over excitement. You don't want to constantly monitor the market. This is why many financially successful people choose passive investing. Here's what many smart investors do. Core satellite approach. 80 to 90% in passive investments, safe, long-term growth. 10 to 20% in active investing, higher risk, higher potential. This way, your core wealth grows steadily. You still have room to outperform if you're skilled. So, which is better? For most people, passive investing wins. For skilled, disciplined investors, active can outperform. But the biggest mistake? Doing active investing without the time, knowledge, or discipline. If this video helped you understand investing more clearly, hit like and subscribe for more deep dive content. And comment below, are you going passive, active, or a mix of both? See you in the next video.